What's going on, guys? Welcome back to the channel. My name is Anfernee McLemore, and in this video I want to discuss how to actually invest in the stock market if you are in your 20s. Now, there are a ton of videos covering this topic, but for the purpose of this particular video, I don't want to jump straight into what you do once you open up your brokerage account. I want to talk about how to set yourself up to invest in the stock market, and then once you build some financial stability or your foundation, then I'm going to talk about the steps necessary to get started investing in the stock market. I think a lot of the times, whether we're teenagers or in our 20s, when we get started investing in the stock market, we are a little bit uneasy about the idea that we may lose money. We're a little bit uneasy about the idea that our investments may go down in value in the short run, even though we know that we're supposed to leave it in there for a long time. So I think that it is very important to take the necessary precautions on the front end, so that way when you get started investing in the stock market, you are a lot more comfortable with the aspect that your investments may fluctuate in value. So all I ask is that when you find one thing of value in this video, that you simply tap that like button for your boy. And now let's get straight into this video. So the very first thing, that if you are in your 20s like me and you're starting your stock market investment journey, what I want you to do first is to write down your goals. I want you to write down your top priorities right now and visualize why you're getting started investing in the stock market. Are you doing this as a get rich quick scheme, or are you doing this to actually build wealth and put yourself in another tax bracket and overall set yourself up for financial freedom in the future? Write down where you see yourself in 5 years, 10 years, 20 years, or at retirement, because by writing down your goals first and foremost, you are giving yourself the roadmap to take once your journey actually gets started. If you just see a YouTube ad or watch a YouTube video about how much money somebody made in the stock market and you start throwing money into anything, you won't have any sense of direction. You won't have anything to track your progress against. That's why I think effective goal setting is so important. It helps you stay aligned on a long-term objective, even when the short-term motivation may sway here or there. So for me, when I was getting started on my stock market investing journey, the first thing that I wanted to do was have a $10,000 stock market portfolio. And $10,000 when I was 17, 18 years old seemed like an almost unachievable amount of money, but I wanted to add another digit to my investment account, and that was my main priority. And I knew that from my personal investing style and how I chose to leave my investments and not look at them a lot of the times, a lot of my gains wouldn't be made in the stock markets going up in value in the short run. But a lot of my gains for that first $10,000 would be my contributions. So once I wrote down my goals, I then understood that in order to reach this goal in the timeline that I have set for myself, I needed to work harder to make more money in the short run rather than just hope my investments go up in value. So that's another strong benefit of setting good goals. You then start to really see and understand exactly what you have to do in order to achieve those goals. And that's the exact next step of my steps on investing in the stock market in your 20s. The second step would be to decide on the most effective and most practical way of achieving the goals that you set out for yourself. Whether it's a short-term goal like I said of getting $10,000, it could even be $1,000 if you're just really getting started in the stock market or saving money. And if it is a short-term goal, you can then decide to yourself, what do I have to do in a timeline that I have set for myself in order to achieve this goal? Now, nowadays, my goals are a lot more long-term. I plan on building a $100,000 portfolio and then eventually $1 million portfolio. So the actions that I took to get to $10,000 are not the same actions that I would necessarily take to get to $100,000. When I was trying to get to $10,000, I was focusing a lot on making money through side hustles like DoorDash and OfferUp and a lot of different flipping iPhones types things. However, now that I'm trying to get to $100,000, my money making opportunities have now shifted from side hustles to building on full businesses that bring in pretty substantial sources of revenue. And as I said, I think that that is one of the most important points. To avoid you feeling anxious during your investments in the stock market, you must have clarity of what the end objective is and how much work it actually takes to get there. Let's say when I was first getting started investing in the stock market, my goal was to get to $100,000 by the time I was 30 years old. If I was trying to get to $100,000 and I was contributing $100 a week and I gave myself a 10 or 15 year time span, why would I feel anxious in the first week if my $100 contribution turned to $99? I would know that the journey was so much longer than that single day that it wouldn't affect the overall outlook of my plan or of my stock market investments. And just because I lost $1 that first day or two, it wouldn't dissuade me of investing in the stock market entirely. And the point I'm trying to get across is that just because you may lose money in the short run in the stock market, if you look at a chart of the overall economy for the past 100 and 150 years, it has been a steady uptrend. Yes, there has been peaks. Yes, there has been valleys. But if you stay in the market long enough, you will undoubtedly come out on top if you remain consistent and you remain disciplined in your investment strategies. The stock market doesn't have to be complicated. All you have to do is put money into quasi companies with a proven track record. And if you let that money sit long enough, you will more times than not come out profitable. And as we're talking about those practical steps when you're getting started investing in the stock market or reaching your goals, I think that it is very very essential to take a step back away from the stock market and first analyze your financial report card today. And some of the things you really want to look for is, do you have an emergency fund set up? Is your emergency fund $1,000? If it is $1,000, is it 3 months worth of your expenses, so that if you lose your job, you'll be able to cover your expenses until you're able to get another one? And if your emergency fund is not $1,000 yet, then your main focus before putting a dollar in the stock market is to get to $1,000 in an emergency fund. And this should not be in your stock market portfolio at all. It should be in a savings account in liquid value so that you can access if you need it in a short period of time. Just having some cash on hand will exponentially give you more peace of mind in your stock market investments, because your livelihood doesn't depend on the value of your portfolio that day. If your portfolio is at $10,000 one day or $8,000 the next day, that is okay, because you are not actively withdrawing from that portfolio to live on. You have a cash reserve just in case something happens, so that you can allow your money to go up and down in value and let it work for you as much as it possibly can. The worst thing that you can do in the stock market is obsess over every single value that your portfolio has. Yes, some days you will be wealthier and some days you'll be poorer, but it does not matter if you stay disciplined. That is honestly going to be a common theme for this video: discipline. But once that you have your emergency fund funded, you're not necessarily out of the woods yet. What you want to do next is pay off all of your high interest debt. And this is going to be anything like credit cards, personal loans, sometimes auto loans, sometimes student loans, but I would say anything over 8 to 10% in an interest rate that is charging you on a month-to-month basis. You need to go ahead and pay all of that off before you start investing in the stock market. And my reason is that typically, on average, you will earn about 8 to 10% in the stock market every single year. Meaning that if you have a credit card that charges 25 or 35%, you are going to be losing money by not allocating your money towards that credit card than you would be by putting that money in the stock market. And another thing that goes to this point is that once you pay off your credit card, you need to make sure that you manage your spending so that you don't end up in a situation where you are carrying a credit card balance on a month-to-month basis. Again, credit cards can be a powerful tool that can make you wealthier if you use them correctly. But a lot of times people let the credit card companies use them and make money from them instead of you making money from the credit card companies in the form of cashbacks and different reward programs that they offer. But once you go through the process of paying off your high interest debt, the next thing that you want to do is actually educate yourself. And this can be educating yourself on personal finances, on how to actually invest in the stock market. But overall, the more educated you are, the more comfortable that you will feel with how you're investing in the stock market. If you just jump in 2 feet in with no safety net, then of course you're going to be anxious. Who wouldn't be anxious? So that's why you should build up your educational foundation as well. As you build up your educational foundation, you will learn that the stock market does this these certain days or does that these certain days. And you'll know that there's overall a cyclical nature to the stock market, so that when you see that you're up one day or you're down the next day, you won't panic because you know that that happens. And educating yourself can come in many different forms. It can come in the form of reading books. It can come in the form of watching YouTube videos like this. When I was getting started on my stock market investing journey, I watched YouTube videos just like this. Once I began to get intrigued of the notion of becoming a stock market millionaire, I then started to read books on how other people did it. And as this aspiration grew, I wanted to start to grow my income even more so that I can grow my portfolio faster. And as that motivation grew, I then started to develop businesses to make more revenue. And all of this starts, as I said in the beginning of this video, of making your goal. Once you know what you're striving for, your body and your mind will then start to create practical avenues for you to achieve your goals so that you can reach them. And once you have the blueprint landed all out, it then is just up to you to execute on that plan. But moving on to the third point of investing in the stock market in your 20s, what you want to do next is actually set up your investment plan. So after you have your emergency fund funded, after you paid off your high interest debt, and after you educated yourself, now you want to actually set up your investment portfolio or have your investment plan so that you know what you're going to do with your money once it's in the stock market. The worst thing that you can do is just open up an account and start throwing money at the first thing that you see. Start throwing money at AMD stock or Tesla or anything that you think is hot right now, because that is honestly the fastest way to lose money, because you're not going to be investing on values. You're going to be investing on social hype, and there's not a lot of monetary significance to be had in the overall long-term value of monetary hype. But the 3 methods that I focus on when I invest in my personal portfolio is number 1, dollar cost averaging. Dollar cost averaging is simply when you buy more of a position or buy more of a stock, no matter what the cost is. I have a set amount of money that I contribute to my portfolio every single month, and no matter if the value is higher than the month before or are lower than the month before, I continue to buy into specific positions no matter what the value is, so that I continue to dollar cost average in that position over time. That is one of the simplest and most effective ways to invest in the stock market. And the next method that I focus on in my personal portfolio is having diversity. Now, diversity is simply not putting all of your eggs in one basket. You want to have exposure to different markets so that you're not totally dependent on one market doing well in a given period of time. I personally like to invest in the United States overall stock market, the United States S&P 500, the total international stock market, and then a few bond indexes as well. So by having exposure to all of these markets, it will allow my portfolio to continue to perform steadily even if one of the markets decides to drop for any given reason. And then the third and final strategy of my investing plan revolves around a popular topic here on the channel, and that is compound interest. I want to let compound interest work to its fullest extent for me, and in order to do that, I have to leave my money in my portfolio as long as possible. I have been watching a lot of motivational speeches on YouTube recently, and one of the quotes that stuck out to me recently is the lily pad and the pond poem. And I'm going to briefly cover it and paraphrase a lot, but it basically goes that if you have a lily pad that doubles every single day, and at the end of 30 days it covers the entire pond, how long will it be until it covers half of the pond? Now, initially your first thought would be 15 days. 30 divided by 2 is 15, but that would be wrong because of the exponential nature of this question. If the lily pad doubles every single day and the lake is fully covered at 30 days, it will be half covered on day 29. And on day 28, it will only be a quarter covered, meaning that for the first few days or even first 10 days, you won't even see a noticeable change in the overall valuation or change in whatever you're looking at. And the idea here is that if you let compound interest work long enough in your favor, that once the snowball gets rolling, once the ball gets rolling, you will start to see exponential results. But with all that being said, my conclusion for this video is to, if you're starting to invest in the stock market in your 20s, make sure you know what you're focusing on. Make sure you know what your priorities are so that you can reach your end goal as practically and as effectively as possible. If you found anything of value in this video, then make sure you tap that like button for your boy, and also hit that subscribe button if you want to see more videos like this. So this video is actually a little bit funny because last night we had a storm in my house and it completely knocked all of the power out in the entire house. It is still out right now. And how I'm recording this video is that I have a generator outside that I have all of my cameras and equipment hooked up to, and it is just steadily getting hotter and hotter in the house as I speak. So this video may not personally do well in the short run, but as I said, it is all about a compounding nature, and I'm continuing to put little seeds on my channel so that as I show up every single day of the week, I am continuing to grow in my skills on YouTube, and I continue to grow on the channel so that one day I can achieve some of the other things that are on my vision board. However, I know that was a little bit of spill at the end of the video, but as I said, I will see you in the next one, guys.